Hi, my name's Leon Rowe, currency trader and trading coach at trading180.com, and welcome to this video on why do bull or bear traps happen. So first of all, if you've never heard of a bull trap or a bear trap, or you're confused as to what a bull trap or bear trap is, then pretty much what you have is a move, right? Let's say for example for a bear trap, right? The market is moving down, right? And you get a continuation signal, right? And let's say, for example, that level is where traders will look to trade the break, right? So the market starts to go through. We get maybe a couple of candle closes on, an hourly or 4-hour, time frame chart, and a candle close will usually signify to a lot of traders that that the level has broken. And then no sooner has the candle closed, depending on where it closes, if it's a convincing close, and then we see a move, higher, right? And then you pretty much just see the market, continue going higher. And it's only really after the fact, right, that this move happens that this is now considered what we consider a bear trap, because traders who are bearish and trying to get short at this level, right, would have been, entering short here, and then now they're kind of trapped in their position if they don't use a stop loss, right? If you use a stop loss and you place your stop loss here, how can you really be trapped in that position? But if you don't use a stop loss, or you remove your stop loss, then you're kind of trapped in your position as you see your profit and loss on your brokerage account get deeper and deeper into the red. So you're kind of trapped in your position, right? And the same thing obviously would be for a bull trap, right? This is just one of the bull traps. We're going to look at a recent bull trap that happened a couple of days ago, with the dollar, right? And I'm also going to explain why it happens as well. So bull trap would be, any kind of bullish break of a level, right? This is just one type of trap where, or what they call the bull trap. And then breakout traders get in, convincing closes above a obvious, level, and then all of a sudden prices will come down. And this is what you would call always referred to as a bull trap, right? And traders being trapped in their position, again, if they don't use stop losses, right? So why do bull and bear traps happen? This is rarely ever discussed, right? So it's because firstly we have what we call the zero-sum game, right? For in Forex, for someone to win, right, someone else has to lose, right? There has to be a winner and there has to be a loser, right? It's just the way that the Forex game goes, right? So whenever you place, let's say for example, you are, let's say for example, you've been caught in the bear trap, right? So you see a level, you see prices break out, you place your stop above the swing, right? Now, whenever you press sell, right, there has to be someone on the opposite side of your trade. You have to have someone to sell to, right? So the broker or the banks or whoever it is on taking the other side of your trade, it's in their interest that you lose the trade, right? So when you press, sell, right, you're selling to someone, right? They're taking the other side of your trade, right? So when you win, right, they lose, right? If you win, they're going to lose. If you lose, right, they win. So how do you lose if you sell? By your stop loss being triggered, right? So if your stop loss gets triggered, right, you're forced to buy back, right, because you sold, and this is a buy order, right? If you get short, then your stop loss is a buy order, and your stop loss gets triggered, and you're forced to buy at a worse price than what you sold at, right? So if you sold at, 10, you are forced to buy back at 20, let's say, for example, when your stop loss gets triggered. And so you make a loss of, 10, if that's £10, $10, whatever it is, right? And that's how it works. And the same thing when you buy. So again, it's a zero-sum game, right? Forex is a zero-sum game. Now, why do bull and bear traps happen? And it's for liquidity reasons. And when I say liquidity, I'm talking about the bank's liquidity. Yeah. So let's go to this article on Euromoney, and I'll put this in the description box below. And it basically talks about pretty much the percentage of banks that pretty much have the market dominance, right? So here it says in 2016, I couldn't find a later article, but it says Citi retains top ranking while Deutsche Bank plummets, JP Morgan and UBS rise. Top 5 market share of all-time low non-bank FX providers make an impact on ranking. So what it is that it talks about market share, right, of the Forex market. And the top 5 banks in 2016, right, had around 40, I think it's a 44%, right? Top 5 own 44% have a 44% share of the market volume, right? And the top 10 banks, right, in 2016 had a 50, I think it's something like a 55 or something like that. Oh, sorry, not 55. I think it was a 65, somewhere in that region. I'm trying to look for it here while I'm talking to you, but where is it now? Anyway, it was above 60 anyway. Percent market share, right? So you can see the top 10 banks pretty much can control and dictate where price goes. If they want to, these banks, 10 banks want to move the market in a certain direction, then if they have a 60% market share, then they're going to move the market, right? So getting back to why the markets move, and it's because of liquidity. Now, if everybody is, let's say for example, everybody's, we'll use a long example, right? If everyone's going long, right, it's an obvious trend, right? And you have the top 10 banks that want to buy, right? They can't buy if there is nobody to sell to, right? Which is what you call liquidity. Liquidity is the number of buy and sell orders within the market. So buy and sell orders will include not just your actual pending order, well, say pending orders, but your active orders, your buy and sell orders, but it includes things like stop losses and pending orders, right? So the total accumulation of buy and sell orders, whether they're triggered or active or not, placed within the market, right? That is liquidity. If you don't have that much orders in the market, it's low liquidity. High liquidity is when everyone's buying and selling and placing their orders, right? But if you have an obvious trend, right, or an obvious people are being bullish or being bearish, in this case being bullish in the market, right, and it's obvious to everyone that they want to be a buyer, the 10 banks who are who want to place orders, and they can't necessarily trade like how we trade as far as retail traders trade, right? They have to trade in a different way, right? They have to kind of scale in. Now, if they place an order, they're placing orders, in thousands of lots, right? Now, you need, obviously, if they're buying, right, they need someone to sell to. And this is where their liquidity issue falls in, because if everyone's getting long, right, where are all the sell orders, right? Who is there that's trying to pick the top of the market? There's not going to be enough traders looking to get short, right? Looking to potentially get short in a bull market, right? So that's where the banks have their, the B10, if you want to call it B10 or 1 or whatever it is, they have a problem, right? So if you're looking for liquidity as a bank, right, what you need to do is look for where there is liquidity, right? And liquidity, if everyone's buying and placing buy orders, is what? Sell orders, right? Stop losses. Stop losses are sell orders, right? So if traders are placing stop losses here, and they've bought here, breakout, and their stop loss is a sell order, right? So you're going to have a whole load of sell orders below obvious areas where traders are basically placing their stop losses, right? So this is where the liquidity is for the banks to look to get long, right? So how the transaction will work is something like this. They will probably say, all right, then, well, as they they are, the market movers, right? If there is, say, let's say, for example, there's like, I don't know, 50 billion, 100 billion, let's say 50 billion worth of, sell orders, right? Down here, and they want to get long, by the way. Remember, they want to get long, right? And they can't get long because if they do buy, not buying at the highs, right? And they're going to get caught out with something called slippage as well, because by the time their large order gets filled, it will be at probably a higher price, because they're the ones that drive the market, right? They need to fool traders into taking the other side of their trade, right? So stop loss orders are here. There's that 50 billion, 100 billion, 150 billion worth of sell orders, whatever the number is, right? A large amount. Now they can calculate how much it's going to cost them to short the market. Now, if it's, let's say, for example, it only costs maybe, 30 billion, for example, right? To move the market down, right? And to get the liquidity that they need, to then be able to buy, let's say, for example, they want to buy the dollar, right? And let's say, for example, there's another, 150 billion here, right? And these figures are just figures out of the air. But it costs them, let's say, 30, 40, 50 billion to potentially accumulate $300 billion, pounds worth of liquidity orders, which then they can fill. So at the same time that they're pushing the market down, right, and they trigger these stop losses, the transfer of wealth is going from the buyer to the seller, right? Or from the bank, because again, this is a zero-sum game, right? To you, as they trigger your orders, right? And you're losing, the money is going from the loser to the winner, right? So not only are they driving the market down, but they're also triggering stop losses, right? Also, at the same time that that's happening, they are able to buy into positions by triggering sell stop losses, right? So as sell stop losses are being triggered, right, who again is taking the other side of that trade as new sellers who are potentially looking at selling because they might think that this level has broken, right? And new traders are getting in. So if they're selling, this is how they induce and seduce traders into getting short, and then they can actually take the other side of their trade by buying, right? So they're able to buy via triggering stop losses, which is the liquidity that they need in order to press buy. So they're taking your money right there and they're making money, and then they're able to place buy orders by inducing and seducing new traders who think that the market is now changing direction, and they can pretty much buy as much as they want. The liquidity is all down here, right? And then what they can do is, fill their orders, and the market ends up going, higher again, right? So that's just an example of, why do bull and bear traps happen, right? Because it's simply a liquidity issue. If everyone's getting short or everyone's getting long, then they need to, get your stop losses, right? So they can make money, and at the same time of making money and triggering the stop loss, from a zero-sum game perspective, they are actually seducing traders into taking the other side of, the trade that they originally want. So if they sell it, if they're, shorters are getting into the market again, they can actually buy with the amount of shorters that they're fooling, right? So let's look at an example of a news trade, bear trap that happened recently, right? And this is on the pound dollar, right? So the setup pretty much is this, right? You had on the Friday the 1st of June, yeah, you had, 1 second, you had for the US dollar, right? You had average hourly earnings come out. It was better than expected. You had non-farm payroll change come out, better than expected. Unemployment rate, better than expected. ISM manufacturing PMIs, better than expected. And a lot of traders, right, including myself, and there's no shame in saying when you kind of get caught on the wrong side of the market, as long as you're doing the right thing, yeah. This is a positive, outcome for the dollar. So everyone thinks, okay, well, I'm going to buy the dollar. Now, again, if this happened on this date, right? This was the candle. This is the daily chart, right? So if you want to be a seller, right, and you want to get short as a bank, right, and there's not enough liquidity and everyone is getting short. Everyone's seen this pin bar candle, everyone's seen the data come out, everyone's pressing sell, 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 sell. Where are the buyers? Where are they putting their stop losses? Right, they're putting their stop losses at levels above here, right? This is where they're putting their stop losses. Right here, right, and anywhere above, swings on, again, the lower time frame, right? This is the liquidity that they need in order for them to buy the dollar, right? Because remember, they want to get short too, but they can't, right? Because of slippage issues, and they can't buy when everyone else is buying because they're buying at such massive size. By the time their orders get filled, they could be getting filled down here. They don't want to buy, at 132. They want to, fill their orders at 135, right? So this is what tends to happen. So traders are starting to think to themselves, oh my days, like, I've just entered, short, and why is the market moving higher? Especially with, the pound being, as far as their economy isn't great. There's not much inflation coming into the market. Bank of England has said this, blah, 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 fundamentally, right? These things take time and can take time. These bear traps and bull traps can take time to fill, right? Because we don't know how much the financial institutions really want to buy. It could take days, it could take weeks, right, for this to happen. Doesn't mean that you should be potentially getting long either. If you're buying value, you look at this as just a buying opportunity, right? Depending on the level that you want to buy the dollar at. Right, doesn't mean that you should actually get long. There are traders right now who are looking at this and trying to take advantage of the pound, and probably will, make some profit, right? On this move. Doesn't mean it was the right thing to do from a fundamental perspective or even a value perspective, right? Unless you believe that the pound is severely undervalued down here, right? But the trap in itself, the bear trap in itself, happened right here, right? Not necessarily from the breakout perspective, even though that is a bear trap as well, but there was a news bear trap because everybody, right, would have, I didn't necessarily get short on this pair, but would have seen this, on the 4-hour chart. They would have seen this massive engulfing candle backed by the news and a positive dollar, excellent data, right? And then you're getting this happen, right? And all this is right now is what we would call the trap, and the trap is from from traders being stopped out, right? And also as well, traders who are not using stop losses and are taking a bigger loss. They're kind of caught in their position, they're trapped in their positions and taking potentially bigger losses than they really anticipated, right? And traders who have basically bet too much on a particular trade, trying to make money quick, rather than betting 1%, they bet maybe 20%, and now thinking that this was a sure thing, and now they're down 40-50% of their account, and maybe getting margin called, etc., right? So they're caught in their positions, hoping that prices will come back down to where their entry position was. And this can keep going up higher, by the way. This can keep going higher, right? And squeeze is what is another term is referred to as the short squeeze as well, right? So traders who went short and now being squeezed, right, as prices start to go higher. How high will this go? We have no idea, right? This is why I always preach, trade with stop losses as well. If you get caught on the wrong side of the market, it's okay. You take your loss, that's it. Your loss is defined. If it's 1%, 0.5%, 0.5% of your total capital, it's only one trade, right? We've got infinite amount of trades to take, right? If you're not trading with a stop loss and you're right now feeling the pain of this going on, then that's unfortunate for you. But that is really the reasons why bull traps and bear traps actually happen. Again, this is the euro, right? Again, this was where so this would have been where traders would have been getting short at some point, right? Only for their stop losses to be, if they're putting stop losses here, they're being triggered, right? And as they're being triggered, right, the top 10 banks or, the banks, financial institutions are able to take your money, and the broker's able to take your money, zero-sum game, and they're able to actually buy, right, more dollars in the face of a rising market. They're buying dollars at 1.17, 1.18, etc. right? They're able to buy the dollar for cheaper, right? While fooling traders into thinking that, the market now is, getting long. We've seen higher highs and higher lows taking place. Follow the trend. The trend is your friend, etc. right? If you're ever wondering why you see good news and the market is, doing the opposite to what is expected, etc., there might be, some other underlying reasons, but more than likely you're in a bull or bear trap, right? And don't worry, just use a stop loss. If you get stopped out, it's okay. Just look for, another opportunity to get short if you understand value. So if you have any questions, just email me or leave a comment in the section box below. My email is info@trading180.com. Let's have a discussion about this. If you think I'm wrong about it, definitely comment, like, subscribe, share as well. It will be very helpful, and hope you have a great trading day and take care.